What's up, everybody? It's Donald, and welcome back to Finance Waves. Today, we're diving deep into Warren Buffett's 5 golden rules for successful investing. These aren't just random tips. These are the core principles that have helped Buffett build Berkshire Hathaway into a powerhouse. These rules have helped Buffett build one of the world's greatest fortunes. And the crazy part is that they're actually pretty straightforward. So whether you're just starting out or you've been investing for a while, stick around because these rules are absolute gold. Let's get started. Buffett's first rule is to invest in what you understand. You don't need to be an expert in everything, but you should grasp the businesses you're investing in. Like buying a house, you need to understand the neighborhood, the property's condition, and its worth. The same goes for stocks. Understand what a company does, how they make money, and their competitors. Buffett calls this your circle of competence. He focuses on industries he understands, like consumer goods and insurance. Buffett avoided tech for years, but eventually invested in Apple. He spent years understanding Apple's products, brand loyalty, and cash flow. When he understood the business, he invested, and it paid off massively. Now let's talk about Buffett's second rule, focus on the long term. Buffett is famous for saying that his favorite holding period for a stock is forever. He's not looking for quick flips or trying to time the market. He invests in companies he believes in for the long haul. Think of it like planting a tree. You wouldn't plant a seed and expect a full-grown tree the next day, right? It takes time, care, and patience for that tree to grow and bear fruit. One of the best examples of this is Coca-Cola. Buffett first invested in Coca-Cola back in 1988 and has held on to those shares for over 30 years. He saw the value in its brand, its global reach, and its ability to generate consistent profits. Even when the market went through rough patches, he didn't panic and sell. This long-term mindset helps you ride out the inevitable ups and downs of the market. Moving on to rule number 3. Look for companies with a competitive advantage, or as Buffett calls it, a moat. A moat gives a company a significant edge over its competitors and protects its profits over the long term. This could be a strong brand like Apple or Nike, where people pay a premium for their products, or economies of scale like Walmart, negotiating lower prices from suppliers. It could also be a patent or proprietary technology, giving a unique market advantage. Investing in companies with a wide moat means investing in businesses built to withstand competition and economic storms. Let's talk about rule number 4. Keep your emotions out of your investment decisions. Buffett is famous for saying, "Be fearful when others are greedy, and greedy when others are fearful." The stock market can be a roller coaster of emotions. When it's going up, everyone's euphoric, throwing money at every hot stock tip they hear. And when it crashes, people panic and sell everything, usually at the worst possible time. Remember the 2008 financial crisis? Everyone was freaking out, selling off stocks like their lives depended on it, but not Buffett. He saw opportunity in the midst of the chaos. While others were selling, he was buying up undervalued companies. And guess what? It paid off big time. Emotional investing is a recipe for disaster. When you let fear and greed drive your decisions, you're more likely to buy high and sell low. Finally, rule number 5, always look for value. This is the cornerstone of Buffett's investment philosophy. He's not looking to overpay for companies, even if they're popular or trendy. He wants to buy a dollar for 50 cents, and that means finding businesses that are trading for less than they're actually worth. How does he do this? He looks at a company's fundamentals. He digs deep into their financial statements, analyzes their earnings, cash flow, debt levels, and future growth prospects. One of the best examples of this is when Buffett invested in American Express back in the 1960s. The company was facing some serious challenges at the time, and its stock price had taken a hit. But Buffett saw the strength of its brand, its loyal customer base, and its long-term potential. And there you have it, Warren Buffett's 5 golden rules for investing like a pro. Understand your investments, think long-term, seek companies with competitive advantages, keep emotions out of it, and always look for value. These principles have guided Buffett to incredible success over decades, and the best part is that they're not exclusive to billionaires. These are principles that anyone can apply, regardless of how much money you have to invest. So start using them today. Oh, and if you want more investing tips and strategies, don't forget to subscribe to Finance Waves for new videos every week. Until next time.